Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Disney, DIS, you probably know the business. Let's look at the long-term performance here. 10-year return is basically flat without dividends. They had a dividend up until 2019, cut it, brought it back in 23, but look at this long-term performance. Yes, there was some upside if you sold during the pandemic, but long-term, this has been a dud, and the discussion is always, well, it's Disney. It's a fantastic brand. You can't go wrong with Disney. They have such great assets, but it's not showing up in the performance. Long term, it was fine. If you go all the way back to when cable was actually a thing, it's, a 6.6% return in the last 20 years. A lot of this was just because the business was so easy. People subscribed to cable, Disney got its affiliate fees, and things were amazing. But then you look at the last couple of years, the last decade really, this is a business that went from 52 billion in revenue in 2015 to 90 billion estimated for 2024. So you're saying, well, the revenue increased so much. Why is the business worth the same? Well, the business is worth the same because your EBIT margins went from 28% down to 14.5% in 23, up to 17% estimated in 24. So basically, your bottom line didn't change at all. 6 to 8 billion in free cash flow in these years, basically 7 billion in 2024. The question is going to be, is the business changing now in a way that makes it an interesting investment? Because Disney is trading at a 5% free cash flow yield. Kind of interesting for a name like Disney. You want to take a look and see if the valuation makes sense. Looking at their last results, you can kind of see the problem and where those margins are coming from. Business is not good in the linear network space. This is their cable business, ABC, etc. They get an affiliate fee for having their channels on a cable network. But as people cancel cable, they get less affiliate fees, less advertising, etc. And this is a business that's driving a lot of their margins, 30% plus operating income margins on this linear networks business that's continually shrinking, down another 200 million in this quarter versus last year's quarter. It's being replaced by their streaming business, their direct-to-consumer business, up 800 million here. But the problem is that business for the last couple of years has been negative margins and now is just cresting into the 0% margin. So that's, reason for celebration, I guess, for investors. But at the end of the day, you've still got a business that you're shrinking that has 30% plus margins being replaced by a business that now has 0% margins. And the question is going to be, how high can they get these margins and how quickly can they get those margins there? I think at the end of the day, the direct consumer business probably has the upside of high teens, low 20s margins, but to reach that, they have to reach scale. They have to do really well at growing membership. And the concern here is going to be that, hey, Disney Plus subscriber growth is kind of slowing. They've raised prices a couple of times. Yes, it's up about 700,000 subs quarter over quarter, but that's not amazing when you consider this business probably has to be 200 million plus to really reach those scalable margins that you need to replace what you're losing. That's years and years and years away at this pace. So I think they have a lot of runway there, but it's going to take a lot of time. It's going to take a lot of good content. And the fact that they're cutting back on content a little bit. One of the things they did in the early part of 2024 is, hey, we're instituting a share buyback again. We're raising our dividend 50%, but we're also going to cut back on some content spend to make those margins look a bit better. The question is, how is that going to impact your subscriber growth? I think that's going to be a negative. I think a lot of that was driven by the activist investor Peltz coming in, kind of wanting some seats on the board. That was kind of their response to that, their pushback, and the activist investor didn't end up getting any seats on the board, but at the end of the day, did force Disney to probably make some changes. He ended up selling at around 120 and the stock is back to where it traded at the beginning of the last 52-week period. So if you're an investor in Disney, you're probably not very happy about that, but maybe from a long-term perspective, those changes will yield some results on the margin side. Then you've got Hulu, another streaming service they've got. They also have a live TV, cable-ish type of online package that's not huge, about half the size of YouTube, but growing a little bit, strong quarter over quarter, but grew year over year. And Hulu's growing as well. And again, what they're doing with this stuff is they're raising prices, I think, a little bit too quickly, but they're also bundling these services together. You can get Disney Plus, Hulu, and ESPN Plus in one bundle for a lower price. And that's kind of their strategy on a go-forward basis. Hey, we're going to bundle everything so it makes it harder for you to cancel and churn versus just having one service. And it's a much better deal if you bundle. So go ahead and bundle and keep the services for longer versus subscribing for 1 month to watch the one movie you want to watch on Disney Plus, because Disney Plus doesn't have that much content, honestly. Then you've got your sports results. This is basically ESPN, Star India. Star India, they're going to ship off to Reliance, kind of bundle that into a joint venture. So I don't know how that'll appear on the results on a go-forward basis, but might disappear and sort of be a minority interest ownership that they have there in that JV. ESPN actually grew year over year, which is interesting to see, but I think this is going to suffer the same fate in the long run, where people are canceling cable. They're going to get lower affiliate fees due to fewer subscribers, and that is going to be difficult to replace. They do have the ESPN Plus service. They're also launching the ESPN standalone app in the fall of 2025 or somewhere around there. So it'll be interesting to see how they replace the lost revenue from the affiliate fees, and how much of an operating income that will have, and how they'll lay it out in the results. But right now, again, long term, this is also sort of a shrinking business, and one that has very high margins that needs to be replaced by something that's probably going to have lower margins. So that's why the stock is performing where it's performing, because margins continue to shrink. They're now starting to grow again, which is why this might be an interesting investment. For the last couple of years, this was very much a period of shrinking margins that now may be turning around and make for some interesting theses on the stock. Then you've got your experience results. And again, this is where I think investors were disappointed with the Q3 results and why the stock is down since then. This is an area of their business, the parks, the cruises, the consumer products, that was growing at a decent clip, talking about mid-teens results for the last couple of quarters prior to the last few. And now it's suddenly shrinking into low single-digit growth. And this is kind of the business that's been buoying the losses on the linear network side, on the ESPN side, and is now growing in low single digits. And the guidance on the Q3 call was that the growth for the next couple of quarters was going to be flattish. And that certainly disappoints investors, because this is also a high margin business. Being flat on the growth side, you're losing the linear networks, which is your high margin business, and you're growing on the direct to consumer side, which is a no margin business. I think the results are going to show that they're moving quickly into getting that direct to consumer side into a margin positive business, because that's what they have to do. And I think that's why they're cutting back on content, so they can at least show the market that, hey, this is a business that's growing, but also the margins are suddenly 5%, which at least is better than negative 10% that it was in the last couple of years or something like that. So as we look at the valuation here, disclaimer, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. Again, Disney is a $156 billion market cap, so not small by any means. $41 billion in debt and capital leases, minus cash, whatever, enterprise value, close to $200 billion on a forward basis, about a 5% free cash flow yield as of today's price point. So, pretty interesting. They were buying a bunch of shares back as of 2018 and before, then cut that back until 2024, and they're buying back shares again now that their free cash flow is starting to trend in the right direction. You can kind of see that the margins here kind of fell off a cliff as those investments in direct-to-consumer ramped up, spent a lot of money on a negative margin business, and now that business is 0% margin, which certainly is better than way in the negatives. And as that trends up, this could become an interesting investment. Dividend-wise, they raised their dividend 50% with their last raise. I think it's going to be closer to 10%. I'm just kind of being conservative on that front. Could certainly be higher, but you can play around with the spreadsheet if you want. File, make a copy. There'll be a link down below. A 1% dividend yield at today's prices, so nothing amazing, but I think it's a dividend that's going to continue growing as long as their free cash flow continues growing. But might not be 50% like it was last raise, but it might be higher than 10%. So play around with that if you'd like. On the revenue side, I'm basically expecting relatively mediocre growth, 2.5% growth this year, then 4% growth for the next couple of years. I think parks ticks up again. Linear continues shrinking, but maybe doesn't shrink as quickly as some of the other competitors like WBD and Paramount are seeing shrinkage in, because ESPN is still a pretty decent business, has good advertising power with their sports rights. The problem on the ESPN side is how much are those sports rights going to cost? They're certainly getting more expensive. That may impact the sports margins. The NBA is basically doubling their cost in the new deal starting in 2026. yes, they're saying, hey, the WNBA is going to get more popular. We have that. The ESPN app is going to offset some of those costs because that's going to raise revenue. But I think people are going to continue cutting cable, and that's going to certainly be putting pressure on the revenue and the margins on the sports results. And then your linear stuff is going to shrink. Margins there are going to stay the same, but the operating income is going to shrink. So it's going to need to be replaced with direct to consumer and improvement in margins there. And that's why they're being so persistent in cutting back on content expenses, which may put pressure on growth there. But if it doesn't, that certainly is going to drive margin improvement. So that's why I'm kind of assuming revenue growth that's mediocre for the next couple of years. Don't think that changes anytime soon. Parks probably ticks up after a period of slowing growth as they expand, as they add new stuff, as people want to visit those parks to see the investments that they're making. And then margins, I think, are going to improve. That they're already showing improvement this year over last year, 300 basis points in improvement. I think the idea here is going to be we're finally getting to a spot where direct-to-consumer is at least going to be a contributor, not a detriment. And even if it's a small contributor, all those other businesses are still operating at a decent margin. They're not shrinking all that quickly. Parks continues to grow. So, direct-to-consumer, parks are going to grow. Sports and linear networks are going to shrink. That's going to put pressure on overall margins. But I think the improvement in margins on the direct-to-consumer side is enough to offset the loss of operating income on the other business lines. And that's why these margins are improving a little bit. And I think as long as Disney can reach, 10% margins on a free cash flow basis in the next couple of years, this could be somewhat of an interesting investment. The risk here is going to be that linear networks, ESPN, et cetera, falls off much faster. The direct to consumer can catch up on, and those margins are pressured. But I don't think that that's something I'm overly concerned about, given the growth and cost-cutting measures they're taking on their direct-to-consumer business and the strategic initiatives they have there. I think the ESPN app could be successful if it's priced appropriately. I don't think Venue is going to be that successful, but it could certainly surprise. So that's sort of where I'm sitting here. 25% of the money going towards buybacks. Could certainly be more if they feel like their stock is undervalued. They have the cash flow to support that. They do have to pay down some debt, but beyond that, they could use that money for more stock buybacks and or some sort of acquisition if things go south in the linear space and something like WBD or some other assets go up for sale that Disney could get into. And I think from a valuation perspective, right now it's trading about a 5% free cash flow yield. That seems about right for a company like Disney. Maybe I'm being a bit too optimistic here. Let me know if you think I am. But if I put the valuation at a 5% free cash flow yield with all of these assumptions, improving margins, slow growth, quarter of the money going towards buybacks, gets me to about a 9% return, including dividends. If I'm aiming for a 10% target return prior to dividends, this is prior to dividends, gets me to a fair value of about $78. Kind of where I would be if I was to be interested in this stock. Like right now, it's trading in a decent area. Doesn't seem like it's a fantastic deal, but it seems like it's an okay price point for an entry for investors. If you're an investor or holder, it doesn't seem like it's a terrible price to buy or hold. But for me, if I were to be invested in another media asset, I do have some shares of WBD that are a complete turd, by the way, and I'm constantly thinking of selling, and I honestly might just sell if it has a little bit of a run up because that business is not doing well, shrinking faster than I'd expected. I would probably sell WBD in order to buy Disney, but in order for me to be interested in Disney, I think the price point would have to be closer to like low to mid 70s as an entry point. And I think this business has a lot of question marks around it, primarily the idea that this is a shrinking business that's a melting ice cube for the part of the business that's generating half of their operating income. And that's a problem. Like if half of your operating income is at risk, that's a problem. I think Parks is going to do fine. I think the direct consumer business is going to continue growing and eventually generate some sort of margin. I don't know how high it's going to go, but then the other half of your business is shrinking and I see no end in sight for that. It's, eventually some people are always going to have cable, but what's the bottom there? I don't think we're anywhere close to the bottom. People are going to continue canceling, moving to other services, especially as alternatives come up. Once the ESPN app comes out, like why even have cable if you're into sports? You can basically get it. You can sign up for Paramount, you can sign up for Peacock, you can sign up for the ESPN app, and you have the majority of sports that are needed. And you can get some other sports via Prime or whatever. So it's like everything's going to be on streaming, and once everything's on streaming, cable serves no purpose. And that's a problem for a company like Disney. That's a problem for WBD, a problem for all of these legacy media companies, that eventually cable is going to serve no purpose because they've released all of these services that make it serve no purpose. And when that happens, these guys better be sure that those other services generate enough margin to offset the fact that half of your margin, half of your operating income rather, is now disappearing. So that's my thought on it. I think for me, it's still too expensive. But if it drops another 10 to 15%, would I be interested? Probably. However, I can see why investors are kind of bullish on this from a, you know, from this price point, because it's still, a 9% return. That's not terrible. There's certainly upside. If linear kind of stops melting as fast as it is, and direct to consumer now is suddenly providing decent margins, this could be a very interesting model, especially if and when parks start to return to growth. Obviously, some activist investor could come in here. They could, Bob Iger is almost done with his tenure. They could hire some amazing CEO, and stuff like that could push this stock up really quickly, because this, at the end of the day, this is still Disney. It's still an amazing brand, one of the most beloved brands in the world. And a lot of people buy it just based on that. It hasn't been a successful strategy for the last 10 years. But now that the business is kind of moving in the right direction with direct to consumer being profitable, it finally could be. So that's my thought on it. Let me know what you think. Comment down below, like, subscribe, all of that stuff. And if you don't like the video, dislike it. It is what it is. Thanks for watching. Bye.